Those responses, the impact on the stock and the bond markets, building a recession-proof portfolio from scratch, the impact on our pension funds, right? Very important. So this and much more. Just reminding you guys, once you tune in, if you have questions to ask, you can just send them in the chat, right? And we'll take as much as 5 questions. An extra special week. It's our 3rd week going live. It's not something we do very often, but it's something very needed in this time, and saw it fit, right? Where we can pretty much provide financial education, financial entertainment to our viewers, right? Our BIInstitute community. So, in case you have questions, please include them in the chat, and it's always welcome to send us our thumbs up to keep us going, and also to send us some hearts to keep us motivated, because we are providing financial education, something very needed in this time. It said that there's always a great wealth transfer during times of financial crisis, or during times of recessions, right? Depressions, you name it. So what we are providing is nothing short of the same. So I see the hearts going up. We love it. It keeps us motivated. Remember, guys, there is episode 1 now posted on YouTube in the bio. So go and check it out. Yeah, I see the hearts going. Keep it going. So we're gonna go to a break in 30 minutes, 30 seconds rather, and then we'll come right back. Well, I guess we're not going to a break. Alright, so welcome. So tonight is a hot topic, recession assured, what's your next move? We'll be discussing a lot of topics tonight, specifically if Jamaica is financially prepared to weather a storm, in the sense of a recession or a depression, right? Bloomberg has priced in a probability of recession at 100%. So we want to explore the possibility and the responses of the GOJ, investors, business owners, and also the everyday folks if a recession should ever hit Jamaica. So we want to explore the impact on the stock market, the bond market. We also want to talk about the GOJ's possible responses, building a recession-proof portfolio. What are some of the technical and risk management tools that you might want to employ if a recession should hit, right? Give me a second, please. Trying to explore the possibility of a recession hitting Jamaica. What is Jamaica's preparedness for a recession, right? So it's a very hot topic. It's a 3-part series titled Recession Assured. What's your next move? We want to find out if investors are financially prepared for a recession hitting Jamaica, right? So again, it's a hot topic. So if you have questions that you'd like to post to our panelists, you can post same in the chat. So title, Recession Assured, what's your next move? Bloomberg Economics has priced in a 100% recession, right? Global recession. So it's not just Jamaican or the Caribbean or US or the Europe region, right? The European region. So we're talking about global wide recession. So we want to explore the possibility of a recession hitting Jamaica and what would be the possible responses of the GOJ. So we want to explore GOJ's possible stimulus responses to a possible recession. We want to explore the impact on the stock market and the bond markets. We also want to look on how we can build a portfolio, a recession-proof portfolio that is from scratch. We also want to explore the impact on pension funds, right? So you have been contributing for, let's say, 40 years, 30 years, 25 years maybe in your case to a pension fund. We want to know what will be the outcome when you get your drawdown from your pension fund, right? So this and much more. Tonight we have 3 panelists. We have the likes of Aaron Miller, we have the likes of Kedan Clark, and we also have the likes of Richard Williams. So we'll be going shortly to each panelist in turn, and then we'll be taking some questions from the chat, of course. So guys, if you have questions for the panelists, if you want to know how to best prepare a portfolio from scratch, how to implement risk management tools and techniques, right? This is the time, this is the place, this is the forum on which you can ask your questions, right? So we have seen where Bloomberg has said that there's a 100% chance of a global recession hitting, and we have seen where international experts have actually elaborated on the fact that a recession has already started and we should prepare ourselves for same, right? We want to know Jamaica's preparedness. We want to know the individual preparedness for it. We want to know if you have cash set aside. We want to know also if you have investments ready and willing to seize opportunities that might present itself. So we're going shortly over to Richard Williams, our first panelist. Richard Williams is head of research at a very prominent brokerage firm, a very close and personal brethren of mine, a very bright guy. We'll have him very shortly for you. He's not there. Alright, so until we get to Richard Williams, which is the head of research, we want to see some thumbs up going. We want to see some hearts, some questions, and it's an extra special week. We're just coming out of Mother's Day. I haven't given any prize, any contribution to any mother, aside from my mother, that is. So we want to know if you are a mother, you can just send us a wave, right? We'll be having a question posted to the pool of mothers. So we say that's a Chelly Benz, a mother. You can send us a wave if you are a mother, right? Shauna Houston, right? Send us a wave. Melo Davis, all right? Chantel Harris, you're a mother? Are you a mother? Chantel Harris, all right. So send us a wave if you're a mother. We have a gift voucher, courtesy of Antoinette Accessories. It's a gift voucher valued $5,000. We'll be asking a question specific to what we have covered today, right? For the chance to win a gift voucher valued $5,000 from Antoinette's Accessories. So we're trying to go to Richard. Richard is the head of research at a very prominent investment firm. We'll have him very shortly for you. He is not there. trying to connect to Richard Williams. So guys, if you have questions in relation to this topic, it will be good to post them right now. We're taking a maximum of 5 questions, right? Alright, we're going to take another 30-second break and we'll come right back. Andre, over on boss. We're going to take a 30-second break and then we'll try and get Richard. Richard is the head of research at a very prominent investment broker. We'll have Richard for you in the next 30 seconds or so. So stick around, right? Don't move.
Me and nothing better on the journey, full speed, double decker. No time to stop, so you get stop breaker. Acting at the street, yo, doggies, dogs, and a beer mong when I turn up nice center. So you have to skiller than Messi shoemaker, like when Walter Boyd has stecker. But you did that when no one has one barefoot on the tar at stepper. But you know about pressure. But you know about pressure. But you know about pressure.
Welcome to another episode of Navigating the Financial Storm. This is episode 3. The topic is recession assured. Is it what? So we're going over to Richard. Richard Williams is the head of research at a very prominent investment broker. Our sponsor for 3 weeks now running. That sponsored us this lovely bottle of Yellowtail. Right, so we are enjoying Yellowtail this week. Right, so guys, remember it's a financial education show. It's also financially entertaining. So if you haven't gotten out something to drink, you can also do so. Richie, we're trying to connect to Richard Williams. Richard Williams. Richie, you there? So, send us some thumbs up, send us some likes, send us some hearts. It's very encouraging. We're here trying to provide you with financial education. We're also trying to provide a financial entertaining program. So I see Richard is saying he is hearing us. We're going to try and accept now. So waiting. You know where to get him on? Waiting on him. Yes. Says unable to log in. All right, we might have to come back. We might have to come back to Richard. I'm not sure what's happening with Richard. Aaron Miller, is Aaron Miller there? Aaron Miller is our second panelist. Aaron Miller is pension fund manager at a very prominent brokerage firm. Aaron Miller. All right, folks, we might have to take another break. We're having some technical difficulties. We might have to come back in 30 seconds. So don't move. All right. We're going to try and sort out technical difficulties. Aaron, welcome. Second panelist. Miller.
Good night, viewer.
Miller. Well gone, man.
Well gone tomorrow.
Welcome to the show, man.
Yeah, thanks for having me. Hot topic tonight. Navigate.
Yeah, I tell you, very, very, very hot topic. And of all of the weeks, I'm bridging. This seems to be the week we're having some technical glitches. But welcome to the show. It's a very down-to-earth show, right? Very simplified discussion, right? The topic is recession assured. What's your next move, right? Introduce yourself to the people and tell us who you are, and let's get into it.
Okay, good night, viewers and supporters. I am Aaron Miller, a fund manager at the premier financial institution in Jamaica and across the Caribbean.
All right. So, Aaron, we have seen where major indices such as the S&P 500 has tumbled by 20% day over day. We have also seen the Dow Jones and the NASDAQ. No exemption to this, right? So in our local context, we have also seen where major fall off has occurred in share prices, bond yields, right? So question to you is, what are the most, how are local funds performing, right? Pension funds performing in this time? Is it a case where fund managers are pretty much weathering the storm, or is it a case where active fund management strategies are being employed?
Okay, so just to create some amount of context and background, we have seen where asset prices globally as well as locally has taken a hit over the past couple of months. In the global space, asset prices, particularly in foreign stock markets, for example, the United States, would have been experiencing bouts of fall-offs, sharp fall-offs, followed by recoveries. And that would have been coming out of the general tense trade relationship between the US and China, as well as the general uncertainties about the overall management of the US economy and the political process as a whole. With respect to our local context, we saw some amount of fall off in our local equity prices commencing in the earlier part of this year. Now, in the first instance, this would have been largely driven by a tightening in JMD liquidity in the first quarter of the year, and this arose from a couple of factors. There were several large transactions that pulled a significant amount of J-dollar liquidity out of the market. So one of those transactions was the JMMB APO, which was raised sometime last year, as well as a proven sale of its access shares, as well as the very largest IPO that was launched in Q1 of this year. So that would have been having some amount of impact in terms of the demand for equities during Q1, which was further worsened by tax obligations by major corporations. Now, what was really the red herring and what really worsened this situation was the emergence of COVID. Now, COVID has been in the public sphere since last year, November, but it reached our shores sometime in March. And that just increased the level of uncertainty about the way forward, about what companies whether or find their way through this major global pandemic. So asset prices continue to decline in that regard. Specifically, the equities market has suffered a deepening in losses, and this would have impacted not only institutional investors such as pension funds, insurance companies, as well as other asset management teams and unit trusts, but it would have impacted the simple man as well, given the increase in participation of the retail investor and the layperson in the local stock market. I mean, our stock market has been the #1 performing market, the main market, in 2 of the last 5 years. And that when you put up against all of the major players, from your NASDAQ to your Dow Jones. So that drummed up way more interest in equities over time, coupled with lowering interest rates and fixed income securities, being your corporate bonds and your government of Jamaica paper. Now, initially, there was a sharp downturn in the equity space, given the announcement of our first COVID patient sometime around mid-March, March 17th or 18th.
16, 17, yeah.
Given how the government and in conjunction with the Ministry of Health has been managing the entire process from a public health perspective, with all of the curfew measures, with all of the frequent updates to the public, I believe sentiment has been slowly shifting over time, and this has been manifesting in somewhat of a turnaround in the equities market. And we've seen that since end April, around about the 28th, 29th of April, the major indices, local indices, have been trending upward. Now, this is not only due to a change in sentiment, but also due to the fact that the tight Jamaica dollar liquidity conditions that was in the market in the earlier part of the year, the situation is completely different now. Now, you may ask yourself, what has changed? Now, the GOJ, through the Bank of Jamaica, injected in excess of 50 billion Jamaican dollars into the market during March. So that's a lot of money out in the market space that is looking for a home. And one of the viable options that some investors see to place that money or offload that money would be in the stock market, particularly given that the prices of several equities would be very attractive as it is now, given the sharp fall off previously. Another area that we see demand for would have been in the GOJ global bond space. Now, this is the GOJ bonds that are denominated in US dollars and are sold on the international market. So for which you have both investors from the domestic market as well as the international market. Now, given the general fallout, slowdown in global economic activity, of course, you would have expected, and it happened, some amount of flight to safety, which means that people basically taking their money out of risky asset types and placing it into more sure or safer asset types. So, for instance, Jamaica's emerging market bonds would be considered one of those risky asset types. So, at the initial onset of the crisis during February, March, you saw where there was a fall off in emerging market bond prices, inclusive of GOJ bonds, given the overall flight to safety. Now, this would have impacted the portfolios of investors holding these bonds, because when the fair value come the end of the month, the values on those assets would have been lower. However, on the flip side of this presents an opportunity because of the inverse relationship between price and return. So, as price on bonds decline, you tend to see an increase in the yield of these bonds. So, savvy investors and investors with liquidity, that would have been an avenue to deploy some of that excess liquidity. And what you saw over time is that as the demand for GOJ global bonds increased, particularly coming from more moderate and riskier investor profiles, you saw where the price slowly inched back up, given the relationship between demand and supply, and the yields slowly came off.
Okay. So, Miller, question to you now. Given all that you have said, if global market conditions were to worsen, as is being remarked by international experts, what would this mean for retirees or expected retirees? Those persons who are expected to retire in the next 1 year or 2 year time.
Okay, so there are a couple of things that come to mind. The two major impacts would be transmitted through depreciation in the exchange rate as supply chains get disrupted, and there is increased scarcity as production across the globe generally slows down. So whenever you have a case of scarcity, that tends to be followed by an increase in prices, because if a particular set of resources are seeking to acquire a fixed or declining set of commodities, naturally that results in some form of inflation in prices, and we expect that to be transmitted to our local economy, given that the majority of what we produce is produced from imported inputs. Also, you would have seen over the past several months where the dollar has been depreciating, and has been depreciating even more sharply over the past 2 months. So we expect this trend to continue. As given in one instance, one of our main foreign exchange earners, the tourism industry, is at a virtual standstill. There is no income flowing in from that sector as it is now. And there's a limited amount of US dollars in the market. And I mean, manufacturers are still operating. They are still bringing in inputs to produce finished products. So there's increased demand for USD relative to a lower supply. So that has been impacting currency.
Question, Miller. So we have always seen where the GOJs issue announcement saying that they stand pretty much awaiting the fact that they are prepared in the event that they need to deploy excess liquidity to the market. Is the case from the retail perspective that there is insufficient liquidity, or from the GOJ perspective?
Okay, so I'll conclude on the original question. So the increased depreciation as well as increase in prices, that would result in a worsening of disposable income for the ordinary person, because your money, the dollar has been depreciating, so the money that you have now is worth less in a comparative sense, and also prices are higher, so you have a lower disposable income. With respect to the BOJ's overall stance in terms of shoring up confidence in the market with respect to the supply of USD, I mean, the bank has intervened twice over the last 4 weeks, and cumulatively they have pumped in excess of 50 million US dollars in the market. However, the pace of depreciation continues to be sharp. And some days the depreciation is in excess of 10 cents per day, which is pretty aggressive. And I mean, even though they have pumped that amount of money in the market and they have a significant reserve, if you should look at the net international reserves, it is in excess of $3 billion. Or in real terms, it can cover up to about 22 weeks of imports of goods and services. Notwithstanding that, in both of the BOJ intervention activity, the market demanded way more money than BOJ sold to the market. So that is an indicator that there is excess demand in the market, and BOJ's approach now, some may view it as piecemeal. It has not been effective thus far in retarding the rate of depreciation. So looking at the level of demand or oversubscription in the market and the fact that flows are absent from the tourism sector, I would think that the BOJ would need to pump maybe another $50 to $100 million in the market to help slow the pace of depreciation and to potentially reverse the trend to appreciation, at least over the upcoming weeks.
Okay, excellent, Aaron. What would you say to the person expecting to retire maybe next year or two, in terms of the purchasing power, right, of their payout from pension fund, right? Is it a case where the purchasing power will totally be eroded? Is it a case where they will be able to purchase maybe less than today's nominal value?
Okay, so purchasing power in the first instance will be eroded given the levels of depreciation that we're seeing now. And at some point, that level of depreciation, it will translate in what you call imported inflation. Because as importers have to spend more local currency to acquire US dollars to purchase their inputs, their supplies, respective commodities, they will have to pass along that additional expense at some point. A lot of these manufacturers and other importers won't be able to absorb that additional expense to purchase foreign currency going forward, and they will pass it along in the prices of their finished products that they are selling to the local market. So yes, there's an expectation for continued depreciation, which will feed into imported inflation and eventually uptick in domestic inflation. Notwithstanding this though, there may be some amount of offsetting effect given the fact that more people are being laid off now. There are less people with a salary coming in, and that would mean that there will be less people with effective demand to go out and purchase items. So I would expect that at some point, aggregate demand, which is just the sum total of what everyone in the economy demands, I expect that to fall off at some point in time, and that could present some amount of offsetting in terms of a run-up in inflation.
Good. I see where Squirrel Entertainment is saying, is this good news or bad news for retirees?
I mean, as far as the erosion of purchasing power is never good news. However, the COVID crisis, inevitably, it will result in a recession locally. I mean, Bloomberg already has a 100% possibility of forecasting a 100% possibility of recession, and the GOJ is now forecasting a downturn or a contraction in the economy of up to 5.1%. But my expectation is that even though some of the gains that the government has made over the past 7 years under 2 consecutive IMF programs have been yielded, given the terrible conditions now, COVID will not last forever. Not only that, economies globally have been moving countries globally have been moving to reopen their economies and get business back up and running through the establishment of general public health protocols. So the catchphrase now is COVID will be here with us for some time, and until a vaccine or a cure arises, we will just have to live with it, and not only live with it, survive as well as thrive with it. As recent as today, the Ministry of Tourism has indicated plans to open up back the tourism sector over the next month or two. I don't know how successful that will be in terms of international visitors, but I mean there could be some gains from the domestic tourist market. So, in summary, it is not the end of the world. COVID won't be. We will overcome this hurdle. Slowly but surely, economies are opening back. The airlines, planes are going back in the air, and it's just a matter of time before we have passenger flights for both leisure and business moving between countries.
Good. So, certainly in the local economy, we have seen some sectors or industries rather being impacted more than others stemming from the COVID-19, right? So, specifically manufacturing, distribution, the financial sector being the top 3. Of these sectors or industries, which would you say you have taken the greatest hit from?
I mean, okay, so the financial sector tends to be exposed to all industries, and it would have suffered from a decline in asset prices, particularly in the equities market and in the fixed income space. Also, financial entities have some amount of exposure to the real estate space, although we have not been seeing any fall off in that market segment as yet. However, manufacturing and distributive sectors, which rely, a lot of them are vertically integrated with the hospitality industry. So initially, they would have seen a significant proportion of their revenues for the people that supply hotels. They would have seen some amount of fall off. However, we must eat, we must consume certain commodities, no matter the situation, no matter the hardships. So I expect these sectors to be resilient going forward. They may not earn, the revenues may not perform at the pre-COVID levels, so maybe a couple of quarters. But the expectation is that over the medium to longer term, there will be recovery. And then as the tourism industry starts up back and they regain that market, the expectation is for recovery going forward.
Good. So last question, I'm sure our viewers are asking at this time. So in our local market, it seems that the prices of houses, right, are always been going in one direction, up, right? Creating what we call a Jamaican real estate bubble. So given Bloomberg's probability of a 100% probability of recession, in your view, what would this mean for housing prices, rental rates, or even mortgages?
Okay, so Jamaica's housing industry, to use a particular term, the performance has been very nuanced over the past several years. Now, some analysts would say that we have been in a housing bubble for some time now, and people have been expecting to burst at some point. However, we say that housing prices continue to be resilient. They're, even with the level of supply, particularly in the apartment space, the luxury apartment space, it continues to increase. The prices of these properties continue to increase with new developments, even though there is significant supply and a limited amount in some segments of the market of available renters. So my expectation is not to see any immediate fall off in housing prices, and the reason being is that there is still a significant amount of local currency liquidity that's in the market, and invariably, whenever there is this excess liquidity in the market, it ends up finding its way in the equities market as well as the real estate market. Because at the end of the day, there are two ways in which you benefit from a real estate investment. In one instance, you benefit from the cash flow, which would be a monthly rental income stream. So that is one way. Another way, you benefit from the appreciation in the price of properties. So even though there's expectations for, in some cases, people may be experiencing increased vacancies on some of their residences, over time, property valuation in Jamaica, the experience has been one where property values have generally trended.
We stuck? Okay. So, Mila, seems that we're having some difficulties. It's a case where we're not seeing you well. We're seeing you, but we're not hearing you, right? So, not sure, you might have to check on your connection. It's a case where we're seeing him, but we're not hearing him. I'm not sure what's happening. All right, Miller, stick around, don't move. I'm sure our viewers have some questions for you, some burning questions. So stick around, don't move, right? We're going over now to Richard Williams. He's the head of research at a very prominent investment broker. Shortly. We have been having some difficulties. I'm not sure what's happening. Richard Williams, bravo. So we're going over to our first panelist. We would have just spoken to Aaron Miller. Richard Williams. Richie. Seems that we're having some technical difficulties tonight. I'm not sure what's happening. Good night, Chanel Jade. Shanice, welcome. Tiffany 876. We have Chantel Aries. So guys, if you have questions for our viewers or panelists, you can go ahead and ask them. Aaron, we seem to have been disconnected. I'm not sure what's happening with the audio. So persons, remember we have good night, Sharon Brown. We have a Mother's Day gift for mothers, right? I know it's late. Sunday has passed, but we definitely still have a gift. It's a gift voucher worth $5,000 for mothers. So mothers out there, if you are listening, we can just send a wave. We'll be asking a few questions from tonight's discussion. And certainly, if you get the question right, you'll be given gift vouchers courtesy of Antoinette's accessories, right? It's a gift voucher worth $5,000. You never know, it might just be a massage, which is well needed in this time, right? Or a bottle of Yellowtail, right? Courtesy of Island Beverages. Or 2 bottles, who knows? But if you have questions, you can go ahead and post them in the comment. You can still go ahead and give us some thumbs up. You can give us some likes. You can give us some hearts, right? It's definitely needed in this time. So we're trying to connect with Richard Williams, is our first panelist. He's head of research. All right, so it seems that we're still having some difficulties with Mr. Williams. So we're going over to Kedan Clark. Kedan would have actually been our last panelist, but we are going to Kedan Clark second, right? Kedan, welcome, Bridging.
Good night, Omar. Good night to you and your team and your viewers.
How you doing, man? How things?
Things good, man. How you stay? I see you doing good things. I see you doing great things, actually.
Well, you know, we are trying to educate, we are trying to provide a financial kind of entertainment for our viewers and communities.
Okay, so it's a relaxed environment, or the jacket should be on?
You can keep on the jacket, man. You can keep on the jacket. How things, man? You're working from home now, or what's happening?
Yeah, man, I'm actually working from home. I can't say that I miss going into the office, though.
So, the topic tonight is recession at short. What's your next move, right? So we have a lot of viewers who are there tuning in. We have a mix of millennials, baby boomers, who just want to hear what's their next move. If they have maybe cash in store, if they have investments which are already taking hits, right? They want to know how can they possibly navigate this financial storm, right? I'll play on the topic again. So the pandemic has disrupted major sectors, right? Industries, you name it, and has impacted most asset classes in the process, right? Some more than others. So question to you, fund manager, right? From your perspective, how should investors be rebalancing their portfolios? What's the ideal asset allocation or mix, right? To navigate this recession that is coming.
Well, you know, one of the things when it comes to just balancing your portfolio on a whole as an individual, obviously not as a fund or a professional investor. We're just talking from the perspective of individuals now. One of the things that you have to look on is what your risk appetite is. I mean, so for example, you want to know, you have to define what is your tolerance for risk. So are you risk averse? Are you risk loving? Are you somewhere in the middle? Now, if you are risk averse, that means you really don't want to take any risk. As a matter of fact, whatever risk that you're gonna take, it's really a risk that you have to take. Meaning, instead of having 100% of your funds sitting down on a bank account, you're going to lose because, as your previous guest would have explained, in terms of purchasing power, the fact that there is an increase in price just by sitting down and having your money in a bank account, then you're losing. So you must take some level of risk, right? So that would be the risk averse person. Now, as a risk averse person, what are you going to do? You're going to try to structure your assets that you own. So you're looking at yourself as like a balance sheet. You're structuring your assets that you own in a manner where the downside risk that is associated from your activity is extremely protected, if you get what I'm saying. So for example, if the most adverse thing happens to your portfolio, you're not going to lose by more than a certain amount. So your ability to lose is capped, right? So a nice little example would be, let's say you have $100 and you are risk averse, then you maybe want to, and I guess maybe we need to discuss the asset classes for those who probably don't know. So the asset classes would be just, equities, fixed income, cash or money market instrument, real estate, right? Those are the basics. So if we're looking at those basics asset classes, then as a risk averse person, you are going to want to, one, ensure that the possibility of a loss in the event of an adverse movement is very low, right? Two, you want to make sure that you have sufficient liquidity. Meaning, remember, you don't like to take risk. So if 6 months down the line, 3 weeks down the line, 3 months down the line, you need to go back for your money, you want to be able to go for your money without experiencing exposure to market volatility, right? So that is something that you're going to take into consideration as well. So a nice little asset mix probably could be 60% of your asset or 70% of your asset heavily weighted on medium, very low medium to low risk instrument. So for example, if you have sufficient cash, then you could put it on a bond, right? But it wouldn't necessarily be a bond that is risky. So if you are going, just like how we have blue chip companies, then if you're going corporate bond, then you want to make sure that the bond that you're investing in is that corporate entity is a blue chip corporate entity. But ideally, you probably would want more of a guaranteed, government guaranteed bond if you're going corporate, or you just want a government bond. The next thing is, because the longer your money is sitting there, the more risk that is associated with it, then instead of having a 10-year bond that has a more attractive yield, you may want to go to a shorter 10-year bond. Because remember, your objective as the person who is risk averse is you want to beat inflation, right? So that is one other thing. Now, So 60%, you try to keep 60% away from the risk. Then you maybe have another, I think I'm going to change that to maybe 60, between 60 and 70. And you have another 40 or 30% that you want to expose to the risk. Now, that 40 or 30% that you want to expose to the risk, you still have to be more careful. You still have to be very careful with that percentage. Meaning, yes, that is set aside to undertake high risk. However, the type of high risk instrument, so the class of asset is considered a high risk class of asset. But remember, you are risk averse. So the assets that fall within that risky class, you want to ensure that those assets aren't risky as well, if you get what I'm saying. So a nice mixture, as I said, would be more like a 60-40, 20% or even 10% equities. Then probably can put another 10 or so percent in corporate fixed income instruments. So if somebody okay, go ahead.
How much money do I need to have under my mattress? That's the question.
Well, firstly, your money should not be under your mattress. That's the first thing. Your money should not be under your mattress, Omara. You know better. The next thing, just to answer your question more directly, it's important to say, it's important to, I guess our grandparents or parents would tell us, one cocoa full basket. You earn today, you take a little from what you earn today and you put it down for tomorrow. So for example, if you're earning $100 for the month, if you were to take $10 and put it aside and you work for 10 months, then you would have 1 month salary. Then now you can do the maths and see how long it will take you for you to have 1 year's salary. So in essence, one of the things that you really want to do is make sure that you put on at least a 10% of your income every month.
Yeah. So all year round, right, we have seen where the investment arms of brokerage firms disseminating information pretty much saying we should buy stocks. Like, is there ever a time to really sell stocks? So the question I'm asking now for viewers, right, who are listening in and who are probably contemplating on selling out a position, right, simply because they are losing money right now and it's best to take maybe a small loss now, right, as opposed to a larger loss in the future, right? Let's say, for example, we have a recession, right? What's your quote-unquote advice to those persons who are probably saying, all right, let me sell now and realize a small loss no than a larger loss?
Omar, you're trying to set me up? Please contact your financial advisor. This is a discussion. We are not here to give you any financial advice. We're just having a general discussion where we're just scoping the things that we can do, some of the do's and some of the don'ts, right? Let's get that out of the way. Right. But let me answer your question. In regards to selling, it's a lot of people always have a propensity to buy, but they don't know how to sell, right?
Right.
Yeah, a lot of people do that. They buy. I mean, if it's good, they buy.
It's always buying, Bridget. It's always buying. When we sell? People might ask, when we sell?
Yeah, man. So I would tell you, so from a position that I used to have, one of the things I used to tell my clients is the first thing that you need to do before you purchase a security is set your targets. And as soon as you meet that target, then you start to gradually reduce your position. So for example, last year and the year before, IPOs they were a big thing. Like you go into an IPO and you make a 50%, you make 100%, you know, you make a 60%, you make a 30%, you make a 40%. A lot of people if they're not getting good advice, they probably, I'm going to use an example, the Select Funds Financial Index, right? I think it's now at 60 cents or something like that. I think it went as high as $1.60, 70 or 80, something like that. Now, you go into this stock, say you have $100,000. Omar, your bridging, your financial bridging, you went to his class and he teach about buying stocks and he teach about valuation and you understand valuation and you go to one of your brokerage house and you say, yo, I'm ready. This stock, the financial index, I like it. I'm going to go and buy it. And you find 100,000 and you buy it. And this thing get to $1.80. And you say, wow, my 100,000 is now 180,000. And you say, you're going to go higher. 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 Yes, there's a possibility that it is going to go higher. But the higher it gets is the lower the possibility for it to go even higher. Right?
Right.
You as the investor should know yourself. So if you go to the wealth advisor, you must say to the wealth advisor, listen, I have a target. This 100,000 that I'm giving you now, I may need this level of liquidity or even 50% or 30% of this liquidity 6 months from now, 1 year from now, 2 years from now, 5 years from now. And then the investment or the wealth advisor may say to you, all right, based on the time horizon that you have this money for, this is what we're going to do. Are you comfortable walking away or reducing your position in this investment if you attain a 60% return on your money? Are you comfortable with a 50% return on your money? All right, you're risk averse. Are you comfortable with a 30% return on your money? And then we reevaluate this thing to see whether or not we want to be in it for a longer period of time. So to answer your question directly, Omaro, the time to sell should have been decided when you were buying.
Okay. So that's a trust me, that's a good point. But a lot of investors, they buy stocks maybe not so much based on valuation, but based on outlook, right, for a specific company, right? So we're looking at now the flip side. So good point. We're looking at the flip side, right? So on the same note of a fall in stock prices, looking at the other side now of the coin, should investors be buying stocks since prices are cheaper in relative terms as compared to all-time highs? Like we see where even some big name stocks are falling way off, right? Should it be a case now where we as investors be buying? Because remember now, we millennials, right? We millennials, we never had money back in 08, in the 08 crisis, right? We probably have a change, maybe a 50,000 or 100,000 somewhere, right? It's the case now that stocks have gotten cheaper in relative terms that we should be buying.
Yeah, so Omaro, you think I'm firing this? You must think I'm firing this when there's a discount and you pack up your things and go to Costco. You don't want no tissue, you can buy tissue. You know what? You don't want one heap of cornflakes or cereal, you can buy one heap of cornflakes. It's not, no, bro. That's not how the market works. At the
technology seems to be beating us from time to time. So, Mr. Clark, we can just continue from where you left off. Is that case that we should be buying cheap stocks now, or is that case that we should be holding cash 30 or maybe 40%?
Yeah, Omar. So really, I think I went all the way around just to get to a point. The point I was really trying to make is it's relative. Like maybe as you have several different types of investors that are out there. You have institutional investors. Obviously, they have the resources to do their research and properly value the securities and determine whether or not it's at a price that they want to enter. And some of them, they may want to take certain risk and all of that. And then you have the individual investors. On the individual investor side, you may have somebody who you'd call that person a professional. They go to all of the seminars, they read all the books, they know how to use a model, they probably have a spreadsheet. Every time they're investing, they know what to do. They're probably exposed to it at university, or they just have a general love for it. They will have a certain level of understanding. Then you'll probably have somebody who is a novice, or somebody who is doing it passively, meaning they're just investing as something on the side. In terms of it's not their profession, it's not something that they do for as a professional. They are no experts at it, or even if they can be experts, they just don't have the time to be an expert at it or whatever. At the end of the day, doesn't matter which class you fall into, it boils down to one thing, that is valuation, right? If you know a fund is worth $100 and last year that fund was being sold for $500 and this year that fund is being sold for $200, the percentage discount that you're getting, we can't even do maths right now, is a whole lot, right? But the fund still worth $100. It worth $100 to you. When you do your valuation, that fund worth $100 to you. So if the fund don't come down to the price of $100, you're not going to buy it. So at the end of the day, as an investor, you need to know what is the value of all of these assets you're seeing being quote unquote offered at a discount. What is the true value? If you get what I'm saying. So obviously there are certain assets that are out there that have fallen now, that will provide you with some level of discount entry, and it will help you to gain a lot of return on your portfolio, or sufficient amount of return on your portfolio in the long run. But at the end of the day, you must be able to identify what the true value is. One of the techniques I will advise your viewers or inform your viewers about would just be using your financial ratios. If you don't know how to use it, then you can probably let your investment advisor give you some information as it relates to how to use financial ratios. So a couple of the popular ratios that a lot of investors use would be the whole book valuation and earnings valuation. So for your viewers out there, they can go and read that up and see if they can get some level of understanding from it and apply it to what's happening out in the
market. Question, I know a lot of persons in the group might be asking at this time. So since you have basically specified asset classes that we can diversify our portfolios by, in some instances, maybe geography, right? Millennial viewers, that is, are asking, what is your, I wouldn't want to say recommendation, but what's, we know certainly that there's the halving of very prominent cryptocurrency right now, right? Is the case that we should be looking to invest there, or should we be holding funds close to our mattresses or our pillows.
Omar, you're setting me up. You're really trying to set me.
You have the option. You can answer, you cannot answer. You have the option.
You know my personal history when it comes to cryptocurrencies. You know, I have a little kind of love for it and thing, you know, look into it all the time and thing. But I mean, cryptocurrencies, depending on many people, there's like a split view. Is it a currency or is it a commodity or is it nothing? You know, it's still being at the moment classified as a asset class. And guess what? Like all asset classes, you have to do your valuation. So you have to do your due diligence. So for example, with an IPO, you're going to read the prospectus. If the stock is already listed, then you're going to read the last annual financial statement. And you're going to read the most recent quarterly earnings report or quarterly financials. If it is a fixed income instrument, then you're going to read the term sheet. If you want to understand it yourself, you make somebody who understand credit risk analyze it for you and give them feedback, right? For a cryptocurrency, if it's an ICO, an initial coin offering, then you're going to read the ICO paper or the prospectus. If it's an existing coin, then you're going to try to find the use case. So you need to have an understanding. So this cryptocurrency that you are interested in investing in, what is the use case? Yes, it is now being offered for 50% less, but what is the use case? So it exists in a particular type of technology, but this cryptocurrency that is at this price now, relative to the other cryptocurrencies, where we are globally now, given the increase in demand to use technology and operate online in the blockchain space or the Lightning network space. This cryptocurrency that you're referring to, how does it fit into that, into the overall system or space, if you get what I'm saying? So at the end of the day, yes, you can go on Coinbase and you can see the prices every day and you will know where they fall, but it doesn't stop at Coinbase. This space is a space that is filled with information. There are several places that you can go to read up on this particular currency or particular coin that you're interested in. Just go in and read it and find how does it fit in with what's happening now. And then now you can make a determination as to whether or not it's a good time to buy that particular coin.
Question from the group. I see somebody asking, if it's a case where you would recommend it to your clients and why? You can choose to answer cryptocurrency, specifically that cryptocurrency that's being halved right now, which in historic terms has always increased in prices, right? When it's being halved, no. Is a case where you would invest? No. Is a case where you would recommend it to your clients? And if so, why?
Which currency are you talking about, Mark? Why don't just tell me which coin you're talking about?
Bitcoin. So we're talking about Bitcoin.
What's the price now? I haven't been on Coinbase in a little while. What's the price?
So somebody's asking from the group if it's a case where you recommend it to your clients, and if so, why would you recommend it?
What's the price?
So, question to Squirrel Entertainment, what's the price you would recommend?
No, I'm asking you, what price is it at now? 9,300. Oh.
9,300.
Coming from a high in 2017 at what? 18,000, and it went back up to what? Since then it went back up as high as what?
About
15, 14?
Yeah, about 15.
15, 14. What's the use case for Bitcoin?
So question to Squirrel Entertainment, what's the use case?
How you quantify that 9,300? or you know that's the real value right now, or if it's overvalued or undervalued. What you're using to make that determination. We could talk about it.
So question to our group, right? Or millennials watching, or persons who invest actively in the crypto market. What's the question again, Mr. Clark?
What the intrinsic value? What did you use to come up with that value of 9,300? Because it's at 9,300 because people buying it at 9,300.
So it's a case. I don't think you want to get into details, but certainly for our millennials watching, right, who might have missed the last credit crisis, right, who are still in university, who maybe have a little bit now to invest relative to 12 years ago, right? What advice would you want to leave them with? Is a case where they should just hold firm and just watch the market conditions, or is a case where they need to be actively engaged in the market to find opportunities?
I mean, at the end of the day, the market is searching for indications as to when the situation is going to improve. So at the end of the day, when new information come to light, people confidence will increase, or people confidence will decrease as it relates to the future, right? So you as an individual investor, one of the most important things that you can do now in a time like this is just remain as liquid as possible. So opportunities will present itself, but you have to try to remain as nimble and as liquid as possible. I think that's what I would advise anybody out there investing right now. Just try to remain as nimble and as liquid as possible.
Okay. In terms of maybe just leaving a final word with us now. Would you recommend diversifying our portfolios in the US and international market, or just stay local?
I mean,
still remaining nimble, you know. Still remaining nimble.
Know what you mean. I know what you mean. It really depends on the type of investor you are. I mean, if you have a million US to invest, then obviously you can take advantage of what's happening in other financial markets elsewhere, and you'll be able to evaluate those assets and see if they meet the investing criteria, and you'd have the opportunity to buy them, and whatever the brokerage fees are, or to set up a fund indirectly, or go through a broker who have a fund somewhere, or whatever those fees are, it will materially impact your return because you have sufficient capital that will allow the investment to make sense. But you being a smaller investor, which I'm assuming probably majority of viewers are smaller individual investors, you don't necessarily need to be looking elsewhere outside of Jamaica, because you can get exposure to other markets by investing in Jamaica. There are several different types of investment vehicles that exist. You can go and directly purchase the asset itself, or you can go through a collective investment scheme, whether it's a unit trust. You have several different types of unit trusts that are out there, right? And whatever that unit trust is, it may give you an exposure to a market that you yourself can't necessarily go into. So, for example, one particular brokerage house may have a US or global equities fund, and you would have done your analysis of what's happening out there, and you find that the stocks that when you look at when they have these unit trusts, they have to disclose certain information. So like what the fund composition is and all of those things. That's written in the document. So if you go and look at the fund composition and you do your research, you probably have investors that come and on your phone or one of those applications, and you will see some stocks that you like. And when you look on what the exposure this particular unit trust has to those stocks that you will like, they say, oh, I'll get 100% exposure by buying this, or I get a 50% exposure. By getting 50% exposure, this I am predicting that this may appreciate in X value. So by investing in this, I can at least get even a 10 or a 20% return from this indirect investment. Forget what I'm saying. So there are several opportunities, but as a small investor, I wouldn't tell you to, unless you have money, I would tell you to take your money and go try to work my brokerage, buy stocks directly. And then you have the foreign exchange market. I mean, that's the most liquid market out there. So there are opportunities there as well.
Excellent. Mr. Clark, it has been a pleasure to have this discussion with you. I know certainly all of our viewers would have thoroughly enjoyed your company, would have enjoyed the information that you would have helped us to really appreciate in this time, this recession, which is assured, right? Thank you so much on behalf of our viewers. If there are any questions from the group chat, right? Persons who might have burning questions for Mr. Clark, you can go ahead and post them right now.
As a squirrel, tell us if you tell me if you answer a question.
It's the same question. Now, so say, Varstar saying, good job, Mr. Clark. It's a good job. Saying good job all around. All right. So certainly, if you have questions, you can go ahead and post them in the chat. All right. We say Daniel Clark saying cause real talk. So it seems that we don't have any pressing issues for Mr. Clark or Mr. Aaron Miller at this time. So we are about 4 minutes away from ending the program.
Omaro, I mean, I just want to tell you, I want to give you kudos to the excellent work that you have been doing. And a lot of people probably don't really know the details of what you have been doing, but as somebody who have known you for a little while now, I just want to big you up. Use this platform to big you up and tell you to keep up the good work. I mean, you are filling a void in the market that is there is a demand really for that in terms of other people trying to get into investing and they want to understand how to invest in financial markets, but they're probably looking, they don't really know where to go to be educated, or some of the stuff that's out there is probably too technical for them to understand. When I see somebody like you offering like a master class, you just come on a Saturday, you come on 5 consecutive Saturdays, and you're breaking it down from, these simple little definitions all the way up to the point where you at least can get to a point where you understand what's happening in the market. I have to big you up for that.
Respect, Bridget. Remember, it's a 3-part series, so certainly I know more viewers love you. I see that Wang is saying that so like the next finance minister, is he related to Mr. Clark? I see a lot of persons saying, asking question about the Forex market, right? Which we'll have maybe in the part 3, right? And certainly Squirrel Entertainment is asking other questions about the government, right? Printing fiat currencies, right? Clark, it has been a pleasure having this discussion with you. I'm going to try and get Richard Williams for about 3 to 5 minutes. And certainly if there are any questions for Mr. Clark, you can go ahead and send them in the chat. We'll pin them and ask the questions.
Thanks again, Omar, and good night to yourself, your team, and the viewers out there.
Richie. Shout out Williams. Richie. Mr. Williams.
Yeah, man.
Jeez, Richie.
Yeah, man, I'm here now.
Don't tell me that your device has been affected by COVID-19, brethren. Richie?
Yeah, and I'm here.
You hear me? Richie? Richard Williams.
Yeah, I'm hearing you in a virgin.
All right. So we're not seeing you, but we can still certainly go ahead and ask you a few burning questions that we have, right? So a recession as defined by Investopedia is a fall off in GDP for 2 consecutive quarters, right? Since the outbreak of COVID-19, Bloomberg has priced in a probability of a recession at 100%, right? Some experts have even went as far as saying that the recession is already here. So from your research, what are some of the early indicators of a recession? Richardo.
Yeah, man, you hearing me?
Yeah, man, I'm hearing.
All right.
Wow. So we're seeing you now, right?
I have no idea what's happening this evening. So, but I suppose.
Reggie, we have about 2 or 3 minutes left, right? Let's see how far we can get. So, recession as defined by Investopedia is really declining GDP, right? For 2 consecutive quarters. We have seen where Bloomberg has said that there's a 100% probability of recession, right?
Mm-hmm.
From where you are sitting, right? You're head of research, right?
Mm-hmm.
What are some of the early warning indicators of a recession? And is the case where Jamaica is even ready for a recession?
Well, that's an interesting question, Omar, because it's like you have a number of horses in a stable, and you're asking me what are the signs when the horse is bolt from the gate when they're already gone. You understand? That's basically the position we find ourselves in. And the truth is, based on the nature of what COVID-19 is all about, and I think Aaron mentioned it in his presentation earlier, it is defined as what you call an economic sudden stop, right? In other words, everything literally came to a halt. And when you see the unemployment numbers in the US, it's basically it went off a precipitous cliff, right? Right overnight, almost 30 million persons are without a job. Some of them are temporarily unemployed. So the question isn't necessarily about indicators of a recession. The truth is, quite frankly, we might already be in one, right? And a matter of technical definition, it is just a matter of convention when we say that a recession is, really 2 consecutive quarters of negative growth. That's a matter of convention. But the persons who are responsible for defining when a recession actually begins and ends is the National Bureau of Economic Research in the US. And they don't generally say that it is 2 consecutive quarters. They just say that it's when there is economic decline across a number of economic sectors, production, consumption, etc. Right? Now, the final point I would want to make on that is that it's not even a case that we need to define this as a recession, because James Bullard, who is one of the Federal Reserve governors in the US, is characterizing it almost as a natural disaster, because that is what COVID-19 is all about. And the important definition, or the importance of making that clarification is that when a natural disaster strikes, then you will want to take all measures possible to deal with the fallout, which is what we are seeing now in terms of the unprecedented fiscal and monetary policies that we're seeing. The US have already spent quite a bit, and a bill is now going before Congress for them to spend an additional $3 trillion US, right? We have seen our own efforts here in Jamaica, 25 billion thus far. I think any Jamaican who is now living and who was born after 1962 is the first they have ever seen the Jamaican government actually give back, some money. And you see the lines all over the place, people standing in, Western Union lines, etc., to get the funds. That is important. Why? Because the most important thing that you want to do, and by you, I mean governments all over the world now, is to maintain the capacity to consume. And the way you do that is to have like direct payments to households, direct support to companies or sectors that are most negatively affected. We're seeing that in the US, where some of the airlines have actually gotten bailouts, so to speak. We're seeing households getting support in the US, the popular $1,200 checks, so to speak. And there is evidence also that some people, especially in the hospitality sector, are actually getting more. The fiscal checks are actually more than what they used to get while being full-time, being fully employed. The point I'm making, Omar, is that this medical crisis requires the full extent of monetary and policy and fiscal policy interventions, which we're seeing. Right, so the issue of a recession to me is a non-starter. It's really about the magnitude of government's response to deal with the medical crisis.
Good, Richard. So excellent points right across the board. Right, it was Winston Churchill who said that a nation which has forgotten its past can have no future. Right. So many historians are drawing parallels of the 1918 Spanish flu, which hit America in the so-called second wave, suggesting that the reopening of the economy could result in the repeating of history. So given the Prime Minister's recent briefing, right, press briefing, could Jamaica headed down a similar road?
Well, here's the thing. The truth is we don't know. What we do know for sure, however, is that human nature remains consistent between 1918 to now. In other words, people get bored, people get tired of being holed up, and they are reasoning in very basic ways. I am not seeing anybody getting killed. Thousands of persons are contracting the virus. I'm not seeing those impacts around me, so I'm going to go out. Right? It's really a natural human thing to do. Having said that, however, we would have seen the admonition from Dr. Fauci yesterday in his testimony to Congress, basically outlining this very same concern. There is the risk that you can reopen too quickly, and then there is a resurgence, right, of the virus. So what I believe could happen, and an interesting research paper came out last week by Darren Asimoglu, who is a really recognized economist in the US, and they have outlined basically a simple set of strategies that governments can consider in reopening the economy, right? And in basic terms, we are seeing elements of that locally, where vulnerable groups are being advised to still shelter in place, that is, Tanya Yard. People should practice social distancing, that is, those who are allowed to go back into the working world. the wearing of masks is important, and practice, the constant sanitization and so forth, washing your hands, prevent, don't, resist the urge to be touching your face, etc. So those simple things. And of course, the test, locate and trace people and so forth, randomized control trials, meaning that, once, you detect maybe a cluster that might lead to community spread, you immediately, try to cauterize that. And I believe we're seeing elements of that in St. Mary, as we speak. So when we put all of those measures together, and I need to add this finally, people have to take responsibility as well, right? So we're seeing videos of persons partying as if, the individual has a responsibility as well. Individual responsibility is crucial and critical here, because the more we float the regulations and provisions, the greater is the likelihood that we're undermining our efforts to have a quicker economic recovery, right? So that's really the most important thing there. But the opening of the economy is, in my view, without a doubt, of paramount importance, and we're seeing global economies across the world beginning to take those steps. Now, your ability to do that obviously is dependent on your fiscal strength, for instance. So when somebody says to you that, boy, one country is keeping their borders closed until September, why are we, considering doing, any such thing, if that were the case? You have to point out that, we have different levels of fiscal resources, and even at the household levels, different income and savings levels also impinge on that decision, right? So in a nutshell, basically, Omar, what I'm saying is that individual responsibility and the strategic implementation of the medical expert or the advice from the medical experts. In our case, the local medical officer, our chief medical officer, and in the case of the US, Dr. Fauci. Well, whether Trump listens to that is a different question altogether. But it has to be a combined effort of the economics plus the medical advice. Because I agree with Trump, I can't believe I'm saying this, but that the cure cannot, be worse than I'm saying the cure can be worse than the disease, basically. That's basically what he said at the outset, because persons' economic lives are important as well.
So, Richard, question. We have seen where the Fed basically thrown out the toolbox, right, of stimulus packages as far as, let's say, $4 trillion, right? Mm-hmm. Even to the point where they have saying Q infinity is not off the table, right? How could this likely backfire on the American economy, given the already inflated debt system, right, coming out of the 2008 crisis? And it's a two-part question for you, right? Because you're head of research, right? What are the possible rippling effects on the Jamaican economy?
Well, the first thing, the truth is, you have to keep in mind the basic premise of what we call modern monetary theory is that once you are printing money in your own currency, theoretically you can print an infinite amount, right? So when the Federal Reserve chairman spoke about 2 weeks ago, and he said that, listen, don't worry about us. We have a lot of money, right? That is basically saying to the Treasury and to the politicians, whatever programs they want to come up with to fund households, to fund consumption, to help businesses, we will print the money, right? That in a nutshell is what you say, because you're printing the money in your own currency. And there's empirical evidence for that. Japan has been doing this for the better part of a decade, going into 15 years now. And where's inflation in Japan, right? The worry is that you will have deflation instead of inflation, Okay.
Good.
So
Good.
so that is not a real concern at the moment, right? What I would say is perhaps a bigger concern is that what COVID-19 has done is it has shown companies and economies across the world how much they're dependent on China. For instance, I was looking at some data where one particular country sources almost 80% of some of their medicinal inputs from China. So when you have an economic sudden stop, your borders are closed, no imports, no exports, you are immediately exposed to that disruption in your supply chain. So what we're going to see after this, quite possibly, is a recalibration of global supply chains. You're going to see probably people taking more of their companies from overseas, putting them back onshore. You're going to see maybe a diversification in terms of trade relationships, etc. That could be a little bit disruptive in the medium term, which could lead to some kind of inflation, right? Maybe we're looking.
Hold on. You mean hyperinflation?
Not hyperinflation, just basic inflation. Because imagine, for instance, you moving a factory in China from China back to the US, just for argument's sake, where the average wages are very, very dissimilar. In other words, in China, you can pay a man probably $10 per hour. In the US, you're going to have to pay him, say, $50 per hour. So you're going to have wage inflation there. Once wage inflation starts to pick up beyond, say, for instance, the Fed's 2% or R-star target, then you might have to think about inflation, interest rates starting to go back up, right? That is a next important variable you have to really think about, that interest rates could begin to rise again from this zero lower bound. And I can't even speak with that in any kind of certainty, because Fed futures are actually printing possible negative interest rates right now.
Richie, I see comments saying you should be very careful of what you speak, you know. There's some comments from the viewers saying being very careful.
Okay.
Go on.
Yeah, man. So you know, you can see, to me, I believe issues of inflation over into the medium term might be a bigger concern rather than a concern about the sustainability of the Fed's money printing, right? The Fed is, in effect, or let me say it differently, the Fed has quite a bit of capacity to print more money. So we're not concerned. The follow-up question you asked is that what it might mean for Jamaica. I think indirectly it is good for Jamaica. And why is that? I'll just point to two basic reasons. Now, one is the support to households, right? Because of those 30 million persons who are now unemployed on a permanent basis or temporarily, they are getting these checks to help them to weather through this storm. Invariably, some members of the Jamaican diaspora are there. So some of that money going over.
Richie, is a one-time check. It's a one-time check.
No, hold on. Remember, I just indicated to you that a $3 trillion bill is now making the round. So by Friday of this week, you should be having some debates on it. We anticipate some kind of debates between the Democrats and the Republicans in terms of what exactly makes it into the final bill. But none of them is contesting the fact that households need more help. What they might debate is whether the federal government should be making money available to state and local governments. So I know Mitch McConnell is not in favor of that. But what we can be confident or we could be fairly confident in expecting more fiscal support for the households. If you can go and ask your viewers and yourself to look at Jay Powell's presentation at the Peterson Institute today, he was very evocative. He used colorful language. The economy is drowning, right? When somebody is drowning, you go and try your very best effort to save them, unless you have some perverse desire to look at somebody drowning and get some pleasure out of it by watching and not doing anything about it, right? So that's essentially what he was saying, right? And I think he was being very strategic in using that language, knowing that this bill is before Congress, right? He's basically nudging the politicians to say, you have to do more. And I believe that that is going to come. So that is good for Jamaica to the extent that persons, when we see the back of COVID-19, it's not a case that you are so far down in the hole that you can't take a vacation again. You're going to come back out. Your finances are fairly intact. And you say, oh boy, me locked down for 2 months or whatever the case is. May I take a vacation to the sunny isles of Jamaica or somewhere else? So the possibility that exists that our tourism numbers could rebound more sharply than we currently anticipate, to the extent that American consumers come out of this fairly strong. The critical linchpin there are the American consumers. If they come out of, because consumption accounts for almost 70% of GDP, right? So to the extent that we can help, and I keep saying we, but obviously the Fed and the American politician, policy making army, if they can, keep consumption fairly solid coming out of this, then the recovery or the rebound could be sharper and quicker than the numbers currently suggest.
Excellent. If there's, I see a question coming in for Richie. I'm not sure if we have the time to take it. So, doing more, we see a question coming from Squirrel Entertainment saying that doing more is masking the situation worse. Can it be good for Jamaica or other country? Stop selling viewers cheap. I say Kool-Aid. Cheap Kool-Aid. Right. I
don't know what that means. Yeah.
Squirrel Entertainment, if there's an actual question for Richard Williams, I just needed to post it in a group right now, and we will take that question. But Richard, definitely an excellent session, very informative. If there's any question from Vardy Star or any other viewers, I'd want you to post same now. We are about to end the program. This is part 1 of Recession Assured. What's your next move? So I don't see any immediate question for Richard.
All right, I think I see something. Is it Squirrel Entertainment? It's more of a commentary saying that COVID is what reveals the flaws of the economic system. I'm not quite sure what he means by that, but there's an important element that he's referring to indirectly, and that is there were some economic weaknesses coming into COVID-19. So COVID-19 just basically made it worse. And it's like you have an outbreak on your skin and something just knock you and it break it out. You understand? Apologies for the crude metaphor, but that's basically what's happening. The good thing, if we can call it that, is that COVID-19 allows the Fed to piggyback on what is a medical crisis to fix what were serious fiscal financial imbalances coming into here. For instance, there were serious concerns about the huge debt load in what we call a triple B space, right? And what the Fed was able to do is to create a facility that facilitates the deleveraging of those entities. Now, can you imagine if we didn't have a COVID-19 and those companies started to go belly up? It would have been a serious political nightmare for the Fed to bail out those companies, right, without this medical crisis, because people are going to say again, yes, the system is coming to bail out the big man, them again, like they did in 2008, 2009, etc. Right? So COVID-19, yes, it exacerbates what were some weaknesses before, but it provides cover for the Fed to fix these going forward.
Good. I certainly hope that has been an adequate response to any viewer that might have questions at this time. We are definitely at the end of our program. So it's a 3-part series, right? I've just spoken with Richard Williams. He's head of research at a very prominent investment brokerage firm. Richard, my brethren, good job, right? So stay tuned for part 2 next week. We'll be exploring again the same topic, recession not sure, what's your next move? Next week, we'll be having the likes of Stanley Thomas and Raman Small Ferguson, right, as panelists. Remember, if you miss last week's episode or this week's episode, you can always catch a recap on YouTube at BIInstitute. Certainly, if you have any topic that you'd want us to speak on, you can definitely send us a comment in the group, and we'll touch on that topic around week 4, week 5, right? So next week, very interesting topic, recession assured, what's your next move? So another big up to our sponsors, Black Knight Graphics, K Studios, Island Beverages, and ANN Entertainment, Loan Hub. So we've seen where Kimala just joined. Kimala, if there's any question for Richard, we'd like to take them. Richard, I'm not sure how much time you have, but I see where Kimala of the lab have just joined. If there's any question for Richard, you can send him in the comment. We're seeing where Coach is saying, good job, Richard. We're seeing a lot of thumbs, a lot of hearts going up, right? We're seeing where Squirrel Entertainment is also saying thanks for the honesty. Squirrel, you can tune in again and have your questions for Richard or Stanley Thomas.
Thompson. Stanley Thompson.
Thompson. So again, guys, next week again, same time, Wednesday, 8 p.m. It's been a pleasure. This is your financial version, Omar Hutchinson.